bicycles. You're in the wrong chair. What are you doing in the second row? Guests in the front, advisors.
It was empty. It was empty.
Yeah, okay. That's all right. He's a placeholder. Walter and I do this all the time. So. Thanks for being here.
Thank you.
I'm Joe Pantozzi, and we're going to talk tonight about private banking, family banking systems. It has different names by different people. I want to start up with a warm-up exercise and ask you, from a financial perspective, what keeps you up at night? Now you'll notice I only have 14 spaces, so we can stop at 14. Okay? So help me out here. A couple of ground rules in your folder. You don't need to go there right now, but in your folder is an evaluation form that we would like you to complete at the end of our meeting tonight. So we would like you to give us your opinion about what we said to you, how we said it, what you learned, how useful is it, how different is it from what you already understood, and we would ask you to be kind, gentle, and gracious to us. Now, I'm only kidding. Be brutal as you want. Another ground rule. When I say you, I don't really mean you. I mean you in general. You the people in this room, you the people out there. Typically, I like to address the audience as if we're all millionaires, multi-millionaires. I'm not here to insult anyone. I'm not here to ask you what your credit card balance is, because I don't believe anybody here has a credit card balance. So when I say you, in a negative sense, I mean the people out there. Does that work?
Yes.
Okay. When I use the word bank, don't let me go over there with Sharpies. Okay. When I use the word bank, we're talking about all financial institutions. So, from a financial perspective, what keeps you up at night? Just throw them out at me.
Retirement.
Retirement.
IRS.
Well, if you would pay your taxes. So we're an entrepreneurial organization, and my wife gets a tax bill from the IRS after we just finished paying our taxes, and there's an under-reporting penalty, and she said, you work on fees. How do we know what our earnings are going to be from one month to the next and from one year to the next? So how can they penalize us for under-reporting? Well, first of all, they're the IRS. They have one rule: we're the IRS. Somebody said bills, right?
Yes.
Bills. No, just kidding. Okay,
Debt.
we're at 3.
Debt.
Debt. This exercise shouldn't take more than 30 seconds.
Family.
Family keeps you up at night?
Oh, mine does.
I agree with you. Thank you. Come on now, there's a lot more.
No sleep.
The economy.
Dogs.
The economy,
Dogs.
from a financial perspective.
Dog's medicine.
If your dog has bills, if your dog is worried about retirement and that's keeping you up at night, I guess we can kind of slip that in there.
Student loans.
Student loans.
Age.
Age from a financial perspective? Meaning? Who said that? Meaning?
Meaning that the older you get, the more concerned you get with what you have
Good.
left to live on.
I buy that. Come on now, only a few spots left to fill. We should be able to get to 30 or 40.
Nightmare.
I worry about my kid being able to survive in their economy when they get to be our age.
Great.
Inflation.
Inflation. Wow, there's 10 spots to get there, huh? That means most people here are not worried about it.
Interest rates.
Interest rates. Interest rates good, interest rates bad.
Worldwide conditions.
Devaluation of the dollar.
Yeah, what's going on in Greece, is it gonna hit America?
Yes, next question.
Politics.
Politics, oh my goodness. That should be 14, 15, and 16, right?
War.
War. What else? I can make 15, it's okay. If you have one that's really outstanding.
Cost of living.
Got it. Cost of living, inflation, kind of similar, right? I was going to say, inflation is not really an issue because the government keeps on telling us that inflation is like 1%, so it's not a big deal. As long as you believe the government, wait until they come out with that tax form that says, what'd you make last year? Send it in. That's the one-page IRS code.
Along with.
Gets
your
rid of all the
bills.
other CPAs.
Along with your billings. Send it in.
Send in the guns, right? Okay. Why does no one ever call out procrastination?
Maybe
A
tomorrow.
little worried about thanks, Kimberly.
Guilt.
I'll get to
That's
that.
guilt.
So guilt and so this is something you could take home and think about. And Anthony will touch on these topics later on in his portions. Cameron Christensen will follow me and talk about a little bit more detail, a little bit more technique about what we're talking about. Anthony will serve as the cleanup batter, and he will touch on some more of these things. But I'm kind of curious, when we go home and think about the things that keep us up at night, what are we doing? What are we planning to overcome these fears? Fears is a big issue, right? And fear sometimes paralyzes us, and we are not supposed to be in fear because fear is really a waste of time, right? This isn't a psychology course, but I consider myself more of a therapist for people than I do a financial advisor. We talk about numbers and money, but we talk more about value than anything else. A man you probably heard of named Einstein said that many things that are of value can't be counted. And a lot of things that can be counted don't necessarily have value. So I'm always curious about why Americans, generally speaking, are not doing a good job at saving, at building wealth. Everybody's interested in wealth, right? Everybody would like to have more money, more wealth, more material goods. We'd all probably rather have more time than money, because money frees us up. Money is just a means to an end. Money is the means of exchange, right?
Same reason we eat at McDonald's. We're lazy.
I eat at McDonald's because I love their fries. I love their fries. And I love their calamari, as a matter of fact.
What? The what?
You can order it special.
Calamari and McDonald's.
Yeah, come on.
Come on, Joe.
Okay, so let's talk about
Lack of knowledge.
your family banking system. Is that on the list?
No, but I'm just saying, that's why people.
Lack of knowledge. I want to challenge every single one of those points, because as a country, we're not in very good shape, right? Financially.
Uh-huh.
We're making an awful lot of money. We're making a terrific amount of money. And I just came back from New York for 5 days, visiting family back there, and you could not walk or drive one city block without coming across massive construction. They're renovating, they're building new skyscrapers, they're taking the old face-off buildings and putting new face on. There's just money flowing in every direction. But we as Americans are not doing a very good job, right? So we won't throw a lot of statistics out, but does anybody here know what the average savings rate is in our country? Negative. It's been negative. About 7 or 8 years ago, it was negative. We were spending $105 for every $100 that we earned. That's because we're Americans and we'll just make more, right? Like the Cheeto commercial. Right? Average savings rate's about 5%?
5.5.
5.5%. Okay. I mean, think about that. This is off the script, but you know, you make $100,000. I hope all of you make more than $100,000, but have to start somewhere. Have to have something to discuss. So we make $100,000, and at the end of the year, we put $5,000 away in some kind of a savings account. Imagine. And then we go 20, 30, 40 years, and we say, well, I can't wait to retire. Gee, what are you going to retire on? In 20 years, you saved 1 year's spending, right? Forget about what you're earning and the risk and all that. Just think about the math. And I don't care how old you are. You need to go home and talk to your friends about this. Talk to your parents. Talk to your grandparents. Talk to your children. Talk to your grandchildren. Ask them these questions. Get them thinking. That's what we do. We spend a lot of time getting our clients to think and figure out why they are where they are. Because you can't figure out a plan unless you know where you are and why you are where you are. Because you don't want to keep on doing the same thing over and over again, right? So your family banking system looks like this right now. And I, like I was telling the gentleman over here, I went to Rutgers, so my thought processes are fairly simple. So this is my money, and my money starts out as income. I have to get my money somewhere, and whether I'm self-employed, whether I work for someone, or whether I'm independently wealthy and self-sufficient, I have income from someplace. And then I take my money, and what do I do with it?
Invest.
That's true. I put generically speaking, as I defined for you earlier, a bank is any financial institution. So I put my money into some kind of a savings, and that can also include investment. So we're just going to use kind of generic terms. So I put my money into savings, and these are kind of two halves of the same story. Now the prevailing theory is, you remember, I'm only putting away 5% of what I'm making. So the prevailing theory is, I'm going to put that 5% away in some long-term savings account that I won't see for a long time. And I'm going to spend the rest of what I make, and for the rest of my needs, because obviously I have more needs than I can sustain with my income, what do? Class?
Months spent.
Borrow.
Yeah.
Borrow. Now, where do I borrow? This is basic economics, and I did not understand this 15 years ago when I was a financial planner for 25 years. So do the math. I'm in my 40th year of financial planning. I didn't know basic financial planning for 25 years. So I know it now. I'm learning more every day, and I'm sharing it with you. So I'm here to share. I'm here to give you a gift. If you learn nothing else tonight, I want you to learn about the family banking system, because you have a family banking system already. You're using it right now. The only difference is whether you're delegating most of that banking function or whether you're controlling most of that banking function. At the end of tonight, you will be able to go home without any further relationship with us. I hope that's not the case, but you can go home tonight without any further relationship with us and improve your financial condition by learning how to control your family banking system. So somebody said, I better put this in red, right? Then we borrow for our excess needs, don't we? Now, let's go back to the middle. We are putting our money in a bank of some kind. And I like to use Bank of America because, as an example, because Bank of America is a big bank. I think they're still the biggest, if I'm correct. And you can go to Bauer Financial, B-A-U-E-R, and get a financial report on any bank you like for about $50. And I went to the Bauer Financial site, or somebody here did. We paid our $50, and we found out that you folks are making a lot of deposits at Bank of America. It's only one bank, okay? This is so interesting. So, I want to make sure we're clear. We're taking our money, putting it into an account with our name on it, and then we're going back to the same bank to borrow money, right? So, whose money are we borrowing in essence?
Our own.
Our own, okay. So, Bank of America had about, I think the number is 800 billion. Don't get caught up in the numbers. We can always give you copies of this. They have about $800 billion of our money. I keep on saying that, right?
Mm-hmm.
And what did they do with our deposits? They lent it back to us. So we went to the bank, we said, hold this for me. When I need it, I'll borrow it from you. You okay with that? This is what we're doing, right? How much are we making on our savings accounts today?
About a half percent.
This, I read lips, I read the spit. That's exactly, so Bank of America paid out last year 0.2% on the 80 billion. 0.2%. I'm sorry, on the 800 billion. They paid out, so we were to the good, $1.8 billion. Now, really, if you had $1.8 billion, you could take off the weekend, you could have a good time, you could own a house on each coast, you probably own each coast. Now, what did Bank of America make by lending us our money? Yeah, how much? Take a guess.
A lot.
You don't, there's no penalties, you get to, you still get dessert if you get the answer wrong.
10 trillion.
1 trillion.
No, you guys are optimists, you should be bankers. The number was 40, and I'm rounding, okay? Forgive me for rounding. 44 billion. So they held our money, they paid us some interest, and they lent it back to us, and they made $44 billion on our money. Now, if we had a credit instrument of any kind, a credit card, car loan, a lease, mortgage, business line credit, we are all good for our word. We believe in working with clients who have integrity and who are teachable. You're teachable because you're sitting in a classroom. Don't tell anybody, you're sitting in a classroom. I believe I have integrity, and I know I'm teachable because I just keep on learning and reading and studying people who are bright and who know this stuff. So, you've already proven that you are good for your word. When you give your word you're going to borrow money, you pay it back. Agreed? Mm-hmm. We, in this room, did not short sell our houses. We didn't default. We don't go stale on our credit obligations. We're all good citizens. Now, what would be the difference? So, let's look at a percentage rate. Now, this isn't exactly what Bank of America has on their financial statement. I'm just talking about the swing between this number and this number. So if I took in 44 billion and paid out 1.8 billion, my swing is about 2,500%, which is good money, right? If you have to work for a living, this is not a bad gig. What the banks do is legal, right? We're not condemning or criticizing banks for what they do. What we want to do is learn from them. I have to write this down in case I forget to talk about it. It is written down below. So how do I turn this around? How do I learn from my own system from what banks do? Well, banks, number one, keep the money in motion. Okay? Banks take the money in savings deposits, and they immediately, and Cameron will give you more detail on this, they immediately pay it out. They don't leave it in the account overnight, they keep it in motion. In fact, they do one thing that you and I really can't do, is they lend out money that they don't have. So if you and I could write checks on negative balances and they cleared, then we could do what banks do, but we can't do that. But we can do something in general that banks do, and that's keeping the money in motion. But what do we do as Americans? What I mentioned to you is that we take in $100,000, we save $5,000, we spend the $95,000, and we put that $5,000 into long-term accounts that we can't get to, called
401k?
Jason. I know that you know the answer.
Just trying to help you along here.
Thank you, appreciate that.
You always run over.
I'm going to run over just for that. Now, see, these are some of the things that are working against us for long term. Right? Number one, we're doing things with our money that banks don't do. So if you wanted to be wealthy, wouldn't you copy the habits that wealthy people practice in banks and big corporations? Banks don't put money away for long term. They keep it in motion constantly. Well, we already discussed the story about interest. Banks don't pay interest, as we saw. Banks collect interest. Right? What's the best way to fight inflation? Best way to fight inflation is to have more money. Best way to fight inflation is not to put your money away for the next 30 or 40 years and having no idea how inflation will destroy the purchasing power of your money. When's the best time to plant a tree? Chinese proverb.
Now, today,
Second best. Second best. First best answer is yesterday, right? Second best answer is today. When's the best time to buy a condo at the beach? Today or 20 years from now?
today,
Today. So here we are putting money in 401ks and future instruments and hoping that we'll be able to have a great life, and we have no idea what that money will yield us in the future. And the other further evidence that tells us that we are not getting success out of what we're doing is that 95% of Americans have less than $100,000 in their 401k. How much can you pull out of a 401k if you have $100,000 in there? $4,000 a year, $300 a month, before tax? Where are we going with this? So we have some issues. We have some self-esteem issues. Okay, we really have to learn to love ourselves better, because if we loved ourselves better, we'd be saving more than 5%. That's the therapy class. That's the 601. We'll talk about that some other time. You need to think about this. Why am I not reaching the level of success financially that I would like to? What is going to happen with our accounts that are invested in the stock market going forward? One thing I can guarantee you the stock market will do is
correct.
fluctuate. It will crash on occasion, but we have no idea when. It will absolutely fluctuate. Banks don't invest in fluctuating assets. Banks invest in all the payments that you and I are making to them. Those are called guaranteed payments. You and I invest in risk. Banks invest in guaranteed payments. Who do you want to be like?
Bank.
Taxes. Are taxes going to go up in the future or down? So we're putting money into 401ks where we're going to have a higher tax bill in the future. We're putting money into 401, and I'm just picking on 401ks. Any kind of a future account can be substituted. We're putting money into 401ks where we have no idea what market losses are going to do to us. We have no idea what fees are going to do to us. You ever hear of John Bogle? John Bogle was a founder of the Vanguard funds. Vanguard funds are a very reputable, very conservative, very economically run mutual fund company, which is probably 70 years old or so. John Bogle, the founder of the Vanguard fund, said that the average investor will lose 40% of their gains in fees. I'm a stockbroker for 35 years. I'm not lying to you. Okay? I confirm this information with my brother. I totally believe in nepotism and whatever you call that. My brother was a 50-year bank employee and officer, started as a teller, finished up as president, chairman, CEO. He knows what he's talking about with regard to banking. This information I'm giving you is true. LOC, lost opportunity cost. If you were going to buy a car tomorrow, what's the very best method of buying that car? Pay cash. Is that true? Or is that just what they told you?
It's true.
Financial planners told you that's the best way. They lied to you. Let's talk about lost opportunity cost. Can anybody here who's not an advisor define that for me? Yes? I don't see your Travis, thank you.
Travis. It's basically the costs or the money you're losing out on by doing something else.
Perfect, thank you. I spent $30,000 for a car. I could have invested the money potentially over the next 50 years at 5%. Guess what my lost opportunity cost is in 50 years? Just take a wild guess. It's okay. I won't bite you. I may take your cookie away. Come on, non-advisors, give me a guess.
$300,000.
Pardon?
$280,000.
How'd you do that? That was really good. So including the 300, it's about 340. So you're right there. So if I had taken the $30,000 and invested it at 5%, I'd have $340,000. That's for one car paid cash. So how do you avoid that? I have to buy a car, and they tell me that buying a car for cash is the best way that I should get my car. Well, if you look at this article, and you don't have to now, but the real key to creating wealth, this was only learned by big corporations 25 years ago. Coca-Cola, Briggs & Stratton, CSX Railroad, companies you've heard of. Okay, and you look at that clock one more time, I'll go to 9 o'clock. You'll just have to drag me out. I have 4 minutes. Okay. These companies found out that the best way to buy things was not to pay cash. Because they had cash sitting in their treasury, and they said, well, we need to go build a warehouse, we need to go do an advertising project, we need to go create a new product. We're just going to take cash and put it in a project, and away we go. Coca-Cola was going bankrupt. And some wise guy from Harvard came and said, do you realize that your money has a cost? You think that you only have to pay a cost when you pay for other people's money. Well, we just talked about this, and this is not other people's money, is it? This is our money. But we're paying interest, kind of through the nose, to borrow our own money. So, pop quiz. If you're going to take money out of your own savings account, should you pay yourself back? A. B. Should you pay yourself back with interest?
Yes.
Do you?
No.
Why? See, you've all been here. You know the answers.
Just because, no.
Well, the number one answer, survey said, is because it's my money, right? I don't pay interest on my own money because it's my own money. But here, we borrowed $800 billion of our own money, and we paid them $44 billion in interest to borrow our own money. So here, hold this money for me, and when I need it, I'll come back and borrow it from you at 5 to 10 to 20 to 30%. And I'll fill out a credit application to do so. You guys, if Anthony and Cameron want me to quit, I'll quit right now. Go for it. Vote.
Whenever you want.
I'm trying to lay a foundation. And the foundation says, if I were to think about my own bank this way, my family banking system, then I would create a repository that I would access, that I would control, and when I go to borrow, I would pay myself interest. So, at this point, the gift I've given you is learn to pay yourself interest on your own money. Bank of America is not paying you any interest, are they? Because most of you have not earned 0.2% on your savings account last year. If you earned less than that, right, this is the average of what they paid out last year. So, if my money has a cost, and I have as much respect for my own money as I have for the bank's money, then I will start paying myself interest on my own money. And I won't take $30,000 out of my account to buy a car and stop there. I'll take $30,000 out of my account to buy the car, and I'll make a regular car payment back to myself. Anthony's going to explain that to you in detail, and he's going to blow your mind when you realize how much money you can make financing your own cars and your own family going forward. That's just cars. Then when you expand that to all needs, homes, college tuition, kids' braces, vacations, businesses, next generation, you can create and maintain and build and protect wealth in future generations for yourself and for the future of your family without taking risk. You can stop your risk taking as of today. Everything I just told you is free. You don't need to buy anything to do that. So, I have a family bank. When I want to take a trip or buy a car, I take the money out of my family bank, I lend it either to myself or to one of my companies, and guess what kind of an interest rate I charge myself? It doesn't really make a difference, does it? As long as it's above zero. Right? I charge myself 12% just because. So what difference does it make if I take it out of this pocket and put it in this pocket? But the thing that I'm capturing is I'm putting it into an account, because 99% of people who tell you that you should pay cash for cars don't have any more money than we have. So then what's the purpose of paying cash for the car if you have no more money? The idea behind the game is to have more money at the end so that you can have a better life, build a better life, whatever you want to do with it, do more good for more people, etc. There are other things working against us. One of the most insidious forces working against us, and I'm 2 minutes over, it's really not too bad for me, is the majority. Anytime you see the majority doing anything, you need to run the other way. What does the majority do with their money? They spend it. What's the majority do with their money? They put it in the 401k, and they have less than $100,000, and that $100,000 is being eaten up by market upheaval, up and down. It's being eaten up by fees. It's being eaten up by the unknown. It's being eaten up by lost opportunity cost, because the longer the money sits there, the less purchasing power it gives us. So when you think about it, and like I said, I went to a large public college, so it only took me 25 years to learn this. You're learning it in 25 minutes. Okay, your growth curve is really accelerated. That's really good. Congratulations. What did I miss? Any of these main points that I missed? So what's the bottom line? Learn how to manage your own family banking system. Learn how to think like a banker. Learn how to keep the money in motion. Learn how to not pay interest out to outside lenders. Learn how to pay interest to your own family banking system. and the truth is, and then Anthony and Cameron will come and contradict me with their teaching, and they should, because what I just taught you was you can do that part without doing anything else. You can use a cash account, your saving account, earning 0 interest, and you can have more money if you follow that banking system up to there. Now, what Cameron and Anthony will show you is how to accelerate, how to supercharge that system, and how to do it exactly the way banks and wealthy people are managing their banking systems and adding additional benefits. Did I set you up?